All right, so our recording has started, so I'll just minimize this thing now, and then later on I'll close it at the end. All right. Okay, so I just wanted to tip you off about this domain of finance called utility regulation. So where you have this is very common in electricity, for instance, electricity, water prices. In India, we don't normally price water, but in many other countries like Singapore, they price water. So products and services are priced to ensure uh, uh, the again I'm not writing that, not writing perfect English. They ensure the utility gets a reasonable return, uh, reasonable return on equity. So they actually focus on return on equity. The way it's done is, so some of you might be doing KPO related jobs. So some of the problems that might come up are things like utility regulation, valuation, or basically setting the prices for utilities. So this is a domain of area of finance. So ensure that you get the focus. What you focus on is a reasonable return on equity. It's generally around. In the past, I've seen cases where generally we focus around 12% or so. So what is the reason on equity, etc. I'm just writing etc. because there's nothing sacrosanct about 12%. Okay, so again, this will bring you back to the CAPM and all that, and how you figure out what is a reasonable return on equity. It will vary from country to country. So maybe I should not even write this because it will actually vary from country to country. So let it be open-ended and let let the problem solve itself depending on which country. Maybe you're in Brazil, then you look at the returns on the Brazilian stock market using the CAPM and all that. So let it be blank. And so this is basically what you really need to focus on is that reasonable return on equity is what they focus on, not return on assets. Okay, so this is basically what they focus on. So this is just something to watch out for. He's talking about utility regulation. Again, not talking about explicitly, but just he's on that point actually. So now we go to page 69. Nothing much more on the page 68. Again, he is basically making these kind of statements, which is really can't predict what's going to happen. So yeah, this is a good one actually. JP Morgan, what the famous JP Morgan, which is basically JP upon Morgan, who is the financier. So this guy, so he's famous for this quotation that stocks, what will happen to stock markets? What will happen to stock prices? They will fluctuate. So this is a good statement because that's pretty much the only thing you can say with confidence about stock prices, that they will fluctuate. Sometimes what we like to say in trading rooms, the general joke is that when somebody asks you what is your view on this market, so you say that the market will go up and down, but not necessarily in that order. The market will go up and down, but not necessarily in that order. Just kind of similar kind of statement, right? So yeah, here now let's look at what we want to talk about here. So how much time it takes to recover, going up to new highs. Okay, to recover the ground lost. So he's talking about why you should not basically suffer from this illusion that stocks are a hedge against inflation. Now he's talking about another topic, which is alternative to common stocks as inflation hedges. And of course, he's talking about gold, which is a very popular inflation hedge. Even today, if you see, gold is a very popular inflation hedge. So, so he's talking about this, and he's talking about how gold has. So unfortunately, these comments are actually not. He's making these in the early 70s, but he has. This is just before you had a meteoric rise in the price of gold. So he's just a little bit. So he's basically criticizing this view. So what he's saying is that those who believe that gold is a hedge against inflation, they are also mistaken. Like, just look at how what has happened is, gold has not really moved up, and all that. But he's talking just before it actually shoots up. So in this case, this is why you should never make these kind of strong statements about financial markets. There's no connection as such. There's basically the only rule which I keep on emphasizing is the only thing you can say about financial markets is that not much can be predicted. Pretty much anything can happen. So I'll just show you how he was. So look at what he's saying. that he's making a very confident statement that he would have done much better than than buying gold. It would have been much better to put your money in a savings bank. He's saying this in a categorical way. Actually, he should only say it about this. So this statement is correct that since 1935 to early 72, the gold price has only gone from 75 to 48. Which actually from this, what he's missing is actually that this is actually a very strange kind of statement for him to make, because you should also remember, do you guys know this actually regarding the gold price? I should make one more point. One is that regarding the gold, okay, now this is the Bretton Woods system. Is anybody asking a question or something? There's some kind of a noise, but anyway, it's better to ask questions with using your voice. Okay, let me mention this point actually, because what Graham doesn't understand, I think, which I find very strange that he has made this comment, because actually from 1945, which is when the Second War ended, 1945 to 1971, the United States was on the gold standard. We had something called the Bretton Woods system, which fixed the Bretton Woods agreement, which fixed the prices of currencies against each other, and it fixed the price of gold at it fixed the price of the dollar. It fixed the price of the dollar to gold at 35. I think it's 35, or I think it was 35, 35 or 38. I don't remember. I think looks likely more likely it's 35. So it was fixed at $35 per ounce. So the official price of gold was basically $35 per ounce. This is actually not per ounce. This also is not correct. It's actually per troy ounce. I don't know if I mentioned. This is another point you need to note. You have to be very specific. You can't make these mistakes. Gold is traded internationally in these are all loose statements. Okay, you can't say troy ounce. You can't say ounce when it's actually troy ounce. Okay, so it's not exactly the same. So you can check it on Google. Troy ounce is not equal to 1 ounce. So the ounce which your mother uses when baking cake, ounce of icing sugar, so many ounces of icing sugar, that ounce is different from troy ounce. It's internationally traded internationally in troy ounces. Okay, that's the using. So when you see the price of international price of gold, that is the price for 1 troy ounce of gold, which, as I said, is different from ounces. Okay, that is one point to note about the gold price. The second is, any of you are aware of this Bretton Woods agreement? Anybody? Bretton Woods agreement and the fixed currency, fixed exchange rates regime, and the fixed exchange, sorry, I write it twice. Fixed. Now you guys have to know about all these things, okay? Because this is again part of your core knowledge as a financial professional, to know about economic history. So this is pretty recent stuff actually. So 1945 is pretty recent stuff. So you need to understand how we came to this system of what we call sort of a managed float, we call this a managed float, a dirty float or a managed float. So these are all terms that you should, I'm going to write down these terms, and it's your responsibility to read up on these matters. I'll give you the name of a book also, which you should read, but it's your responsibility to read up on these matters and make sure you understand what happened. The fixed exchange rate system from 1945, after the end of the war, to 1971. I'm not writing the two. So 1945 fixed exchange rate system, 1945 to 1971. Okay. Then in 1971.
So in this,
Yeah. Sorry. Come again. Yeah. Go ahead.
so in this agreement, I think dollar is pegged as the currency value as against every currency.
Yeah. So basically, what happened was that they fixed the price of all the currencies against each other. I mean, they fixed the price first. They fixed the price of dollar against gold. Okay. So the price of gold was fixed at $35 per troy ounce. All right. It was fixed at. So I'll just give you a brief introduction since the lecture is recorded. You can listen to this introduction. So I'll give you a quick economic history lesson. This is important. All these things are very important knowledge for any finance student. If you don't know about economic history, and then later on you can read the book and refresh your knowledge. But basically, what happened was after 1945, because a lot of devastation in the war, these guys got together at a place called Bretton Woods, and they came up with the Bretton Woods Agreement. It had many parts, but one of the aspects of the Bretton Woods Agreement was the fixed exchange rate regime or system. So there, what they did was, dollar is one USD is sorry one T troy ounce of gold. Troy ounce of gold is equal to USD 35. Okay, and other currencies rates, as you correctly mentioned, other currency rates, other currency rates. Uh, Actually should be exchange rates. That would be better. That would give the concept of exchange. Other exchange rates. So these are fixed exchange rates. So it's a very different system from what you have today, because what you have today is broadly a floating exchange rate. So Bretton Woods 1945 to 1971 is actually a fixed exchange rate system. That's why I'm calling it a fixed exchange rate system. Other exchange rates, um, fixed against dollar. Again, obviously, and therefore fixed against. First, you fix the dollar to gold, and so gold, 1 ounce of gold is worth $35, and then you fix other exchange rates against the dollar. So everything is fixed. So you have a fixed exchange rate system from 45 to 71. It was a pretty long period actually. So what happened was, in this period, the U.S. started running budget deficits in this period, and so these other the trade deficits. So they started running. So you have to go back to your macroeconomics. You have to connect to your macroeconomics. What happens when you have a trade where your trade balance is your current account balance? They started running current account deficits, mainly driven by the trade deficit. So you have to remember all this stuff. You have to refresh all this stuff. Current account deficit, trade deficit. So when you have a current account deficit, what happens to your capital account? Can anyone tell me? What do we learn in the balance of payments? So if your current account is running at a deficit, what statement can we make about the capital account? Is it in deficit or surplus? No?
Deficit.
Yes? Come again? I couldn't hear the full word.
Deficit, sir.
Surplus.
It will be
Deficit. You said deficit.
yes, sir. If there is a trade deficit, then our current account will be negative, no? Because
Current
we
account.
have more
Sure.
import.
Yeah. Current account. I said my question was, if I tell you that a certain country is running a current account deficit, what statement can you make to me about the balance of their capital account? Can we make any kind of definitive statement if we know that, say, Brazil is running a current account deficit? Can we say anything about Brazil's capital account position? Is it going to be surplus or deficit? Is my question clear? That I'm not talking about the trade deficit right now, although the current account deficit generally contributed, the main contributor is the trade deficit. So if you're running, I'm talking about the current account. If I make a statement that Brazil is running a current account deficit, my question is, can you then given the information I shared with you, that Brazil is running a current account deficit, can you make a statement, a definitive statement about Brazil's capital account? Is it going to be
So
surplus or?
then it is in surplus.
Correct. Very good. So this is why we call it the balance of payments. So this is all basic stuff which many of you have forgotten now. See, basic macroeconomics today I'm sure has been taught to you. Now you have forgotten all this basic stuff. So you have to keep on revising all this stuff. Okay. So the balance of payments has to all. That's why we say the balance of payments always balances. So if your current account is in deficit, your capital accounts has to be in surplus. It's just like a balance sheet. Assets and liabilities must equal. So therefore, what was happening is that the US was running trade deficits, current account and trade deficits, yes, and then basically also running current account deficits. And all these guys were basically piling up, all these other European countries like France and all, they were piling up dollars, which is basically their capital account surplus. They were piling up dollars, and what the French, there was a little bit of politics in this. The French leader, Charles de Gaulle, he didn't like the Americans. I mean, the French have never liked the French have never liked the Americans. So they can't forgive the Americans for saving them from the Germans. So the joke is that the French hate the Americans because the French can never forgive the Americans for saving them from the Germans. But so the general is that Charles de Gaulle, the French leader, he wanted to make things difficult for America. So what all the dollars that France was piling up, they used to keep submitting the dollars to the U.S. Treasury and say, okay, now you give me gold in return because gold is only worth like $35, right? So all the dollars they piled up, they kept on asking for gold from the U.S. Treasury. So now the US was in a big problem because basically the US gold reserves were going down because the surplus countries in Europe were, especially France, they were basically submitting all their dollars and saying, okay, fixed price, 1 ounce of gold is $35. I gave you so many dollars, now give me gold. So France was taking gold from the US and giving them dollars in return. So Nixon, the US President Nixon, did not like this. So one fine day in 1971, he just woke up and said, okay, folks, the game is over. This whole Bretton Woods business, I'm tearing up the agreement. Now we are suspending the convertibility of the US dollar into gold. Okay, so at that time, the US had a lot of very anti-capitalist regulations within the US as well. So basically, the US one day just woke up and said that I'm not going to honor this agreement, and I'm suspending the convertibility of the US dollar into gold. So then the gold price started shooting up, okay, because now you knew that this fixed business of fixed price is gone over. The US is not willing to play the game anymore, and so Nixon unilaterally basically tore up the agreement. So this is what happened. Now, that is how you ended up with this current system, where now then, since obviously if it's not fixed, then it's floating. So the whole fixed exchange rate, Nixon basically just destroyed the whole fixed exchange rate system, and then everything started floating. So if it's not fixed, then it's floating. So now everything is floating around all over the place. So you can see what happened so that happened in 1971. I don't remember the exact month, but it took a few months to get that thing officially, but it was the bad news were already in. So then this is where if you look at the gold price now, this is just showing you how premature Graham's comment is actually. And so first of all, this to mention this without mentioning the Bretton Woods Agreement and the fixation of the gold price at $35 per ounce from 1945 to 1971, that also is not actually appropriate. He should not be saying this without mentioning that, because most of this lack of fluctuation is based on the fact that it was already fixed up until 1971. So this is not a very, this is a kind of a disingenuous paragraph. I'm sure he knows about the system. So now let's look at the gold price, okay? Uh, Continue without disabling. Okay, let's look at the gold price. Now this is actually with, let's try and show you. Now this is, I want to just disable I've given the link in your notes. I want to disable, this is a real gold price. I don't want a real gold price. I don't want log scale. I don't want to show recessions. Okay, now look at the gold price. Okay, see now you see most of the time it's fixed because at 1971 that's when it really starts to jump. Now it starts to jump. You see most of the time it's fixed at 35. Maybe there was, yeah, $35. See, well, maybe there was a 30 cents or something to it, but $35 an ounce. That's when it starts to move. When Graham is talking actually at this time around 1972, this is very unfortunate for him because this is when the gold price really starts to move. And then you had this big move up to about $800. It's not shown here, but it actually traded at $800 because this is a closed chart. It's not a high-low closed chart. Okay, it's not a bar chart. It's a line chart. So it shows only the closing values. But in fact, we know from the stories in the market that the gold price traded at $800 in 1980. So it was a tremendous rise in the price of gold, which these people had never heard of, had never seen before. So Graham's comment is very premature because just after he made the comment, the gold price started shooting up. So this is what happened. And then after 1980, you can see the consolidation. And again, this rally is basically this is where if you see, again, you connect it to the stock market. This is the bursting of the internet bubble. And as the central bank started expanding money supply, and this whole thing is based on the expansion after the then you had another round of monetary policy expansion after the financial crisis, which is the September to 2008, the sort of peak of the crisis, the Lehman Brothers bankruptcy. But even after that, the gold price started going up. Then again, a little bit of a decline. Again, it's going up because again they're expanding money supply desperately. this, yeah, you can see even after COVID, this has gone up. So basically, the main point I was mentioning is to understand the gold price, the movement of the gold price. It gives you a long-term chart, and to understand a little bit of economic history. This statement is actually not correct. Okay, most of it is explained by the fixed exchange rate system, but you need to know about all these things. The Bretton Woods Agreement, how they fixed it around after the war, and how Nixon broke the gold standard. So the U.S. was on the gold standard, and then eventually he took them off the. He just suspended the convertibility. So basically, he told the French that get lost. I'm not going to give you gold in return for dollars anymore. Okay, that's just that system is over. So this is basically what happened. So you need to know about all these things. So I'm just going to talk about the gold price, and I think this should be a separate topic. Bretton Woods Agreement is a separate topic. So this is something you have to study. Now the book you can use, I can give you this book. It's called uh, International. I'm sure you can find it on PDF Drive. I've not checked it, but because I read this book, actually, this was a very interesting book to share with you on a personal note, with you all. This was actually the book that made me fall in love with finance because I did my summer training at Lintas. I used to be a copywriter in college, so I used to write captions for ads, and I used to earn a lot of money actually in college as a student, writing captions and copy. Copy is basically the written part of an advertisement. Those of you who are interested in advertising, copywriting is the writing the text of the advertisement. So I used to write. So one of my slogans is used for the Bata. The Bata had a shoe called North Star. So I had one of the North Star campaigns is based on my slogan, which is the world at his feet. That's the North Star person. So I'm wasting a little bit of time telling you my personal stories, but anyway. So this is also again connected to some knowledge about the industry. What is copywriting? Copywriting is the text in the advertisements. So I did my summer training at Lintas in Bombay, which is an advertising agency connected to Unilever. So while I was doing my internship in Lintas, summer training in advertising, I one of my friends who was doing his internship in Citibank, he had this book. Okay, this book is by a guy called J. Orlin Crabb. He's a Wharton professor. So while he had this book, so I read this book. I took it from him, read the book, and this is the book that made me fall in love with finance. So I gave up advertising and marketing, and I was going to go into advertising, and then I went into finance. So this is a special book for me. I'm mentioning this. So all this stuff I told you, I learned from this book. You can find this book on. I'm pretty sure you can find it on PDF Drive and stuff. So make sure you read it. All right. Okay. So right now. Yeah, he's talking about how gold does not lead, yeah, there's no income on capital. This is also not a correct statement, actually. This is also not a correct statement. So we need to make this another point, okay? Um, mm, uh, along, let's say people who are just, I didn't want to use the word people who are long gold. It's not correct to say that there is no income. Maybe that the income is low at a point of time, okay, can earn a yield, okay, known as the gold lease rate. So you should know about this thing, that there is something in the market called a gold lease rate. Now, at a point of time, it may be a low figure or it may be a high figure, depending on what the supply-demand balance is for gold at that time. But there is something called a gold lease rate. So when you are long gold, it's not, what he's saying here is actually not correct. Again, that you have, he's suggesting to you that the holder of gold has received, generally does not receive any income. That's the nature of his statement. But that's actually not true. So because you're failing to mention in the international gold markets, we have something called a gold lease rate. Because there's a massive market in London for precious metals. It's called the London, I mean, it's managed by the London Bullion Market Association. You can actually look, you can look up LBMA, okay, which is the London Bullion Market Association. You'll get a lot of information about the precious metals market in London. It's a huge market. It's a center of the global market in physical trade in precious metals. So and other metals are also traded in London. are centered around London, which is aluminium, zinc. These are base metals. So all the metals trade is actually centered in London. So if you know, there is something called a gold lease rate, okay, which you can earn. So if you're long gold, you can lease out the gold and you can earn a gold lease rate. Now, what that rate is, that will depend on market situations at point in time. So it's not true that people who are long gold do not earn anything. They earn a gold in the international gold markets. At least you will earn a yield known as the gold lease rate. Okay, so in addition to the, and then so of course remember, what are the two components of the return on any asset? I have taught you this. What are the two components of the return on any asset? So gold lease rate is your gross yield. So the two components are net yield and price variation. Didn't I teach you this before?
Yes, sir.
Yeah, so you guys are forgetting all this basic stuff. This is basic theoretical frame. These are some parts of your basic theoretical framework. Any asset in the world that you look at, you will know that it has two components. The return from that asset has two components. Either there is some assets they may not be a gross yield, okay, but generally most assets you have some kind of gross yield. From the gross yield you subtract your cost of funds, and that gives you the net yield. So you have to look at how much money did you borrow to buy. You assume everything you buy by borrowing. You borrow money and buy everything. Whenever you buy something, you put it on deposit. That's what we assume in finance. That everything you assume that you borrow money and buy it, and whatever you buy, you assume you put on deposit and try to earn something on it. So this is related to the gross yield on the return on the asset, which is the gross yield. And once you subtract the cost of funds, so maybe you should do this recap once again. This is very basic stuff, guys. You can't forget all this stuff. Okay, gross yield minus minus cost. These are basic framework, theoretical frameworks. Any asset you look at, the return will have two components: gross yield and um, not gross yield, actually net yield. Gross yield minus cost of funds is equal to net yield, right? So gross yield minus cost of funds is equal to net yield. That's one component, and the other component that you have in the case of any asset, you'll have another component which is going to be the price variation. Okay, total return from any asset, okay, is equal to total return from any asset. Basically, this is again recapping of theoretical frameworks. They are so basic and so important that I'm recapping it once again. So total return from any asset is net yield, okay, is equal to net yield plus price variation. Net yield plus price variation. Okay, net yield plus price. Why do I write price variation? Why don't I write price appreciation? Can anyone tell me? Normally we write price appreciation. Okay, but why is that not correct? Why is it more correct to write variation? Right? This is also a lesson in communication, how you should communicate in any given situation. Can anyone explain why I'm not writing price appreciation and writing price variation? No? Because this
So
return,
because price,
yeah. Sorry, go ahead,
so
Soumya.
because prices can depreciate as well.
Yeah, correct. Very good. So, therefore, as I said, this is a lesson in communication as well. Whenever you talk about a situation where you know that the return can also be negative, and as some of you pointed out, that the prices can depreciate as well. So that's why you don't write price appreciation. That means your statement is not general enough. But if I write variation, now you see it's a general statement. Variation covers both appreciation and depreciation, right? So, therefore, this total return from this asset is going to be a function of net yield plus price variation. Okay, so if you have price variation, that's a much more general term. Which price variation is a much more general term, so it's better than writing either appreciation or depreciation. All right. Okay, so this is a basic concept which you need to make sure you refresh and understand. You can apply this in any situation. If you look at stocks, you have dividend yield in stocks. Dividend yield is actually what? What is it? Net yield or gross yield or price variation? In the case of stocks, if I say dividend yield, what is it? Gross yield, net yield, or price variation? Yes? Question? Yeah. What is it, guys? Quiz. Uh, uh, s- the dividend yield on a stock. Should I call it gross yield? Should I call it net yield? Or should I call it price variation? Anybody? No? Dividend yield in a stock investing situation is part of the gross yield, because from that you have to subtract your cost of funds to get net yield. Can you hear me or what? Everybody's gone silent. Can you hear me? Yeah? You guys can hear me?
Yes, sir.
Yes, sir.
Okay. So why are people not able to answer that dividend yield is going to be, so when you look at dividend yield, the reason I gave you this general framework is that it applies to all asset classes. Okay, any situation. So in any situation you have this situation where you can apply this framework. The return from any asset is going to be a net yield plus price variation. Okay, and in this case of the stock investing situation, you will get a dividend yield that is actually in the category of a gross yield, because you have to subtract from the dividend yield, you have to subtract your cost of funds. So your total return on the asset is the dividend yield minus the cost of funds plus the price variation of the stock. Okay, so that's your situation, right? So please understand. So please make sure you understand this framework and remember this general framework. In most books, you'll not find this mentioned. It's a very simple framework, but it's a general framework that covers all situations. Okay, bond price also. If you see, you look at a bond price, all the coupons that you get, discounted coupons, you're discounting by the. If we go back to our bond price situations. So again, this framework is quite important. So I'll just spend a little bit of time going back and explaining it to you why you can fit it into any framework. Okay, if you look at, we are looking at, one sec, we go back to our bond price situation where I gave you some, yeah, here, look at this. You see, what did I say? The total return from any asset is price variation plus net yield. Okay, so here you see, in the case of a bond, this is the net yield because this is the gross yield. Okay, this is the gross yield, the return from the asset. And why is it net yield? The ratio is net yield because you are discounting the gross yield by the cost of funds, cost of capital, right? So, and therefore this is just cost of debt actually, but this is like the cost of capital. So you're discounting it by the cost of funds. So this expression becomes net yield. This alone is gross yield. Okay, return from a bond again consists of two parts: gross yield, whole ratio is net yield, and towards the end again you have again discounted to present value. Even the price variation component has to be discounted to the present values, using present value. So this is the 1000 out of that is the price variation return. In this case the price variation is zero because the bond, or maybe it depends on, yeah, the price variation, no, it's not zero in this case. You see this, you bought the bond at 965 and redemption price is par value is 1000. So that $35 is your price variation. Of course it has to be discounted and brought down to the current time zero on the t0 on the timeline. Okay, but once again you see, any asset return is gross yield plus price variation, yeah, the gross return, and then the net return is the net yield plus the price variation, and discounting it again using time value whenever, using time value of money whenever it's required. Okay, so is this clear now? You have understood? It's a general framework, so you should not forget these things. These are general frameworks these are actually my frameworks. You don't even see this in any book as such, but these are very general frameworks which you can apply to any situation. That's why I'm teaching you all this stuff. So you should remember this framework will be very useful to you in any situation where you have this kind of any asset return to be considered. Project also, if you see the price variation component when you do project NPV, where is the price variation coming in? Do you remember in project NPV? You remember a term called salvage value in project NPV? So the salvage value of the project is actually the price variation component. Okay, in a project finance situation, price variation. So even a return from a project, you can see you can fit it into this framework because the salvage value of the project is actually the price variation component. And then you have the net yield, which is all the cash flows discounted by the cost of capital. Right? So remember this framework, okay, which basically which you can fit into any kind of framework. All right, so let's look at some other pages. One sec. Okay, now let's go to the next. See here what else he's saying. Okay. So fine. Again, the gold actually moved quite a lot. Even today, you see a lot of people because again there is a lot of money. There's a lot of inflation happening in the U.S. markets, and as you know, monetary policy continues to remain extremely loose, and the Fed is also giving guarantee after guarantee to investors that we will not raise interest rates. So even when they start tapering the quantitative easing and pull back the money supply a little bit, even then they're giving assurances to the market that we will not raise interest rates. Don't worry, please don't sell off assets. So the central banks are so scared of the market going down that basically that everything, you know, e- basically that's why investors are bidding up asset prices, because the central banks have essentially assured them that we will not raise interest rates and don't sell asset prices. So everybody therefore getting a free guarantee from the central bank. That's one of the reasons why asset prices are going up so much. So all right, so basically this is talking about other categories, okay, other variables, other kinds of investments that you can make to protect yourself from inflation. Now there's a term that you should learn here. There's these types of investments like diamonds, old masters, paintings by masters, Picasso and Rembrandt and all these kind of people. Okay, so old masters. Then you have fresh paintings also. There are new things also called NFTs. Have you guys heard of NFTs? No? Nobody's heard of NFTs? Non-fungible tokens. Okay, you guys are not listening to all these programs which I've asked you to listen to. Bloomberg Technology. Old man like me is listening to these programs, although I am not appearing for any interviews, and I don't need to appear for interviews. But you guys are not listening, so you have to stay in touch with what's going on in the world. Okay, so you should know collectible means all these examples which are given on page 70. Okay, collectibles are these examples which are given on page 70, and like diamonds and first edition books. You can also add Rolex watches. I'll just add, okay, Rolex watches, and then examples on. I'm not adding the examples that are already there on that page. So you can have Rolex watches, old model watches, and then you can also have NFTs. Please research NFTs. Okay, this is a new thing in cryptocurrencies. That kind of a digital, just all based on distributed ledger technology. So you guys have to be in touch with what is going on in the world. I mean, you're so young. You guys have to be. You should be teaching me all this stuff instead of that. I'm teaching you all this stuff. NFTs. Okay, these are known as. That S should be small actually. NFTs is non-fungible. I'm just going to write it like this: non-fungible tokens. Please do some research on this. Okay, please do research on this whole cryptocurrency segment. At the very least, you can at least watch Bloomberg Technology on a regular basis. All kinds of companies are coming up. You have all these high-tech companies like Coinbase. Coinbase is a really high-tech company, very profitable company. They launched their IPO, one of the very few tech companies that I've heard of ever, that they did an IPO. I think they did a direct listing. They didn't do an IPO. But anyway, they went kind of listed their shares publicly. Okay, so direct listing means that no capital is raised. And another possible interview question: the difference between an IPO and a direct listing. In an IPO, you're raising money. Okay, in a direct listing, you're actually raising fresh capital in an IPO. You're selling new shares and raising fresh capital. In a direct listing, you don't raise any capital, you don't need any capital, but you want to provide liquidity for your shareholders. So you list your shares from being a private unlisted company. You list your shares on the stock exchange, and then the shares are freely tradable. So the guys who provided you venture capital financing and all that, those guys can now get some liquidity for their shares. They can sell their shares. So this is a direct listing. This is what is meant by it. So Coinbase did a direct listing. So Coinbase is a very interesting company. I'll just write the name here as a connected company. So research this company. Now, why am I saying Coinbase is a very high tech company? Of course, they're doing all this stuff. It's a cryptocurrency exchange kind of setup, and they're very revolutionary because it's a pretty big company actually, and they made a profit of I think $600 million or something in their first quarter as a public company. And in fact, and the interesting thing is that these guys don't have a headquarters. They have no physical headquarters. So if you see today where many institutions are actually doing on-campus classes because there's a perception that online is somehow bad, but actually here you have a revolutionary new company like Coinbase, which is quite profitable and a big part of the Bitcoin kind of cryptocurrency universe. These guys have no physical headquarters. Before their listing, they actually removed their physical headquarters. So they have no physical headquarters. They operate online, and everybody is in different centers. So many companies are moving to that kind of model. Okay, there's no physical headquarters, no physical location. So that's why I'm saying that these guys, they're thinking is the company to watch out for. This company, I think, will go places because they have a very revolutionary way, a very innovative way of thinking. So anyway, so this I just wanted to mention. So I'm surprised that you guys don't know what NFTs and stuff. You should be knowing. You should be aware of all these things. Okay, so the point I wanted to teach you about was there's this term called collectibles. Okay, so basically what I wanted to mention was collectibles. Okay, so this is a collectible is a minor asset class. Okay, so you have major asset classes like currencies, you have equities, you have debt, you have commodities, you have real estate. These are all big major asset classes. So there are some minor asset classes, and one of these is basically collectibles. So we call this, the expression we use is collectibles. So that's what you need to know. And so this refers to all the stuff he's discussed here, okay, like this, old masters, and also like stuff like Rolex watches, old model Rolex watches, all this kind of stuff, stamps. So this is just another term that you need to learn, collectibles. So I made a note of that. Okay. So yeah, you can research Coinbase, research the whole cryptocurrency universe. It's a very interesting universe. So much is happening. Because again, what's going to happen is the reason you need to do it is because this kind of stuff is going to take over the world of finance, quite significant chunks of the world of finance, and it's going to affect all kinds of industries. So you have to know about this distributed ledger technology, all the stuff that blockchain is, that Bitcoin is based on. You've got to know this stuff, so make sure you keep reading on it. Okay, so here okay, he's just saying that what Graham is trying to say is that don't go into all these fancy investments. But actually, there are funds. There's also funds, I don't know if you know, but there are funds. Actually, a fair bit of money is invested in them, actually, hundreds of millions of dollars. There are funds which invest in wine. As you know, wine is more valuable the older it gets. So there are actually funds which can attract hundreds of millions of dollars, which are investing in wine. So they buy cellars and they store physical wine. So this is also stuff that goes on in the world of finance. So you should be aware of it. Although he's saying that it doesn't, it's not an investment operation, but that's not really true. There are people who actually are running a business in these kinds of domains. So anyway, he doesn't want to do it. That's fine. Now he's talking about real estate. Again, real estate actually has done quite well after the financial crisis, but then it's all based on location. Certain areas have not done well, like Dubai real estate has faced a lot of problems. But so you have to see in real estate, as they say, the real estate main important thing is there are three things important in real estate, and the joke is the three things important in real estate are location, location, and location, right? So everything is based on location. So a lot of interesting, it's a very interesting asset class. So a lot of the private equity players are investing in real estate. So, and many of you have family businesses that are connected to real estate. So you can also make this into a specialization to understand the market very well. So this is private equity is very active in this particular domain. So here, what he's talking about, the investor, Investor of moderate means has, you can't diversify because you don't have that much money. So that's why you invest in mutual funds, right? So that the logic is basically, the logic of a mutual fund is that it's mutual, kind of, where basically people get together and pool their resources. So the fund, each person doesn't have enough money to diversify a fund, their personal fund, but they pool their money, and then the fund, when it's investing, is big enough and it can diversify. So each person then ends up owning a part of a diversified portfolio. So that's basically the logic for mutual funds. Okay, so maybe I should write this as well, because I don't think many of you are, all of you at least, are clear about this. Okay, so the logic for, we should write this as a separate point, which is the logic for mutual funds, okay, is that individual investable funds, individual investable funds are too little, okay, to allow to permit the building of a diversified portfolio. Okay, so pool your funds along with the funds of other investors, other retail investors, form a mutual fund. Okay, a mutual fund. That's where the expression comes from. Okay, this is big enough. Okay, this is big enough to permit the building of a diversified portfolio, and so every individual, so basically by pooling your funds you've achieved something you could not achieve on your own. Every individual owns a small fraction of a diversified portfolio. Okay, and again, when we talk about this you should be aware of this, that what is the logic, you should be aware of this. But at the same time, again, when you hear the word diversification, you should always remember that most of the successful investors in equities, it's Buffett or Charlie Munger or Howard Marks or even Mark Cuban, who's actually not a equity investor, he's a private equity guy, entrepreneur kind of person, but even he doesn't like diversification. Most people really don't believe, most of the successful investors like Soros, even Jim Rogers, all these guys. Jim Rogers actually worked along with George Soros in the Quantum Fund. So these are all guys who basically say that put all your eggs in one basket and watch that basket very carefully. So they don't really give a damn about diversification. So that's another thing to be aware of, because diversification is something that is worshipped by academics, certainly worshipped by academics. But many highly successful fund managers don't really give a damn about diversification. So, and I think they're perfectly fine doing that, because as long as you have some kind of risk control, you don't need to have diversification. If you have tight stops on each of your investments, so as long as you know, if you can control your loss on each investment, then you don't really need diversification. So that's something to be aware of. But this is the logic that I just wanted to make sure that everybody, I think by this time, I mean, I'm pretty sure that many of you were not aware of this logic, so I think it was worthwhile explaining that. All right. So now let's go back to this and see if we have anything else that we want to talk about on this page. Yeah, diversification. Yeah. Okay. Yeah. Okay. So conclusion is basically that he's saying that you can't really go whole hog into stocks or whole hog into bonds. You have to have some kind of balance. what he's saying is, yeah, if you're getting 7.5% YTM on telephone company bond deals, so telephone company is basically here. He's talking about utilities. See, the other thing that you need to be aware of, that this I talked about this utility regulation, that the from an investment point of view, yeah. So the investment point of the other thing you should be aware of is that in the investment world, these guys have a kind of a special place because these guys are not likely to ever go out of business. So these guys have a guaranteed kind of return on their equity, not a very high return, but it's a guaranteed return. So these guys are generally considered a very safe bet. So when he's talking about utility, why is he talking like this? You have to understand the background here. Why is he saying that risk involved in buying in telephone company bonds at 7.5% are much less than those involved in buying the Dow? Okay, so why is he saying that? Because this telephone company is basically representative of a utility. Okay, the telephone companies are utilities. So this is a utility. So he's basically going back to this system, to this just kind of a general principle in the world of finance, that utilities are considered to be, although they actually have stocks trading on exchanges, but these guys are considered to be a kind of a special type of equity, because utility stocks are considered to be a fairly safe bet because they're very unlikely to go bankrupt, and so they're generally likely to give you a kind of a assured return. So that's why utility stocks have a particular special place in investing. So you need to be aware of that, and that is the background from which Graham is making this kind of a statement, that telephone company bond means it's very safe because the telephone company is a utility, right? So that's another point. We just mentioned utility regulations. So I'm not mentioning this because it's just a small point, but you should be aware of this, that yeah, that he's talking about this telephone company because it's a utility, right? So he's talking about again what he said in 1965. Yeah, you got to always have common stocks in your portfolio. That's what he's saying. Okay. Do you know this? There's something. There's an area called financial planning, of course, which is one of the kind of typical jobs that you could have. Areas, job in financial planning. Now, do you know how you're supposed to the split? Okay, if I talk about this, one thing I just thought I would let you know, because these are jobs that you might have, might interview for, because there are lots of jobs in financial planning. So I'll just mention this. Um, yeah, defensive investor cannot afford to be without an appreciable proportion of common stocks. But I'll just mention something about financial planning. Okay, now the you also have designations, like in the U.S. they have a certified financial planner designation. So just like you do your CFA and FRM and all that, one of the things you can do is the certified financial planner, CFP. I'll just mention that here. It's a US designation, but maybe they offer it in other countries as well. Just in India, I'm sure there'll be a designation in India as well. Now, financial planning. Okay. Now, what is the relationship between? The question I want to ask you is, make sure that you understand this concept, or this kind of theory within financial planning, a general theory, the relationship between investor age, investor age and um, percentage of equities in an so I'm clarifying, this portfolio does not have things like currencies and real estate. The percentage of equities in an equity plus bond portfolio, if you have a portfolio which has equities and bonds, an equity plus bond portfolio, equities and an equity plus bond portfolio. All right. So what I'm just trying to ensure is that everybody knows this general principle that is followed in financial planning when you're giving advice. So financial planning is where you're giving advice to customers. It's kind of like on how to. So this is financial planning. Remember, I gave you a link to an interview of Mary Adois, who's the head of Adois, or whatever her surname is. So she's the head of wealth management at JP Morgan. So financial planning is more like wealth management than like asset management. Okay, asset management is the specific job of managing a portfolio of assets, whereas wealth management is a broader concept which includes asset management, but includes wealth management includes other things like your estate planning, your tax planning, other kinds of all other financial active expenditures and things like that which you have to plan for. So financial planning is again a fairly broad concept. It is not just investments, but it's more like wealth management in the sense that it refers to the broad area of planning for all your financial affairs, your estate planning and all these aspects. But one of the areas we look at in financial planning is that is this what he's talking about basically. This entire discussion, if you see in this book, a lot of the discussion is based, if you can see several times he's mentioned that oh, you should have like anywhere between 75 to 25. So your stock holdings can vary. In a very aggressive investor, you can go up to 75% stocks and 25% bonds. If you're very defensive, then you have 75% bonds and 25% stocks. All this stuff. So this is all about the percentage of equities in a. If I mention percentage of equities in a equity bond portfolio, then by default, the percentage of bonds is also determined. Okay, assuming we hold no cash. So, if in an interview question, if I ask you, what is the if you want to be a financial planner, so in traditionally, what kind of advice do we give customers when it comes to the relationship between the investor's age? We can call it this. We can write on give an apostrophe s here. Investor's age and the percentage of equities in his so again I'm writing his, but his includes hers as well. So percentage of equities in his equity plus bond portfolio. Is my question clear? I mean, it's a long introduction, but you're needed to be just you need to be aware of all these connections. Okay. So in financial planning, what is the relationship between an investor's age and the percentage of equities in his portfolio? Can anyone answer this? Is my question clear? What is the relationship when a customer comes to you? You generally look at his age and you recommend a certain mix of equities and bonds. So what is the relationship between the age of the investor and the percentage of equities in his equity plus bond portfolio? Is my question clear? No? The question is clear, but I guess I don't know. So anyway, I'll give you the answer. The answer is actually the relationship is inverse. Okay. Okay. So you should know these things before you go for financial planning interview. So there are many jobs these days in financial planning. All this, although they call themselves asset managers, what is this? This company? I'm forgetting the name of the company, but this is. Um, I'm forgetting the name of the company. It's a stock brokerage actually, which they had a India Info Line. Okay, I forgot India Info IIFL. Okay, so India IIFL Financial Services. Okay, so IIFL basically these guys had a asset management financial planning kind of division, and that it was involved in so they had asset management and they had wealth management division actually of IIFL. That they have actually separately spun off that division and listed it as a IIFL Wealth Management. So it's quite successful. It's one of the success stories actually of how taking a financial planning business and scaling it, and then listing it on the exchange. So this guy is one batch my senior from IMM, the guy Nirmal Jain, who was basically one of the founders of IIFL. So this is a very important success story in India. So that's what I was mentioning. This company that in India this has taken off in a big way. So the relationship is inverse. So you might have interviews with financial planning companies. So basically, young investors. Okay, the logic is that young investors have a long, um, let's put this in bracket, earning, uh, the thinking is that they're going to be working for a long time, so they're going to be earning salary, so they have a long earning career ahead of them. Okay, so they can afford to take more risk. Okay, so obviously if you can afford to take more risk, hence uh, percentage equity, I'm not writing very perfect English here, but I'm just, you get the point. Hence percentage of equities will be relatively higher because equities are riskier than bonds, right? So the equities get paid last. If you remember the hierarchy of claims, which I discussed in the during the Solomon case, that the secured creditors get paid first, then the unsecured creditors. Then, of course, you have the preference shareholders and hybrid capital holders, and then last is the equity capital, the guys, common shares. So basically, equities are more risky than bonds. So logic is that young investors having this career, long earning career, so they don't need to get a good return immediately, so they can afford to take more risk, and their equities uh, will be higher, much higher in their portfolio, high proportion of equities in their portfolio. That's why I said the relationship is inverse. So if your age is low, percentage of equities in your portfolio is, we should write this word, model. Okay, we can say model portfolio is an ideal portfolio. Okay, ideal, like we have model answers. This ideal portfolio is inverse. So if the investor comes to you and is a young guy and he's going to be working for for a long time, so you allow him to invest a great deal of very high percentage in equities. But if it's an old man, obviously maybe he's already a pensioner, he's not going to work anymore, and he only has a pension income. So make sure he puts a lot of his money in fixed in debt, actually, debt securities. So this is just a little bit of financial planning logic, okay, which you should understand, I think, because if people were not really 100% clear about. So a lot of the basics, I just want to make sure that everybody's clear, although it's kind of basic stuff, but it's better to, tell you and make sure that everybody's clear about it, because some people may not be clear about it, and these are things that everyone needs to be 100% clear about, right? Okay. So if you look at, so here we say defensive investor, this is basically what he's talking about, a little bit on that, but he's talking about defensive versus aggressive, but I was talking about young versus old. So when you look at commentary on chapter 2, this is ending on page 71. Okay, so there's one more point I wanted to make about page 71, which is um, logic for mutual funds. There's one point. Financial planning, this is a separate point, so there should be a star there, and this logic is part of that point. Okay, now on page 71, this is happening on page 71. This, yeah, I talked about this. So as far as the general, so there's the reason I mentioned tips is actually because this chapter is about investments and inflation essentially, right? And whether the larger question of whether stocks are a good hedge against inflation. Now, actually, so he's discussed various other hedges. So the main problem is we're trying to deal with how do we manage inflation? I mean, how do we deal with the problem of inflation in investing? That if we may get a good return on investment, but if the inflation is very high and investment returns are not directly proportional to inflation, then our real return is reduced. So one thing you have to remember in this context is, so they are searching. So if you see in this book, he's also describing the search of investors for a appropriate inflation hedge, looking at gold, looking at other commodities, looking at collectibles, all right, all these kinds of things. So they are searching high and low for a good inflation hedge. But there is something here in the world of bonds. Do you remember something which you've studied? Okay, now of course I've given you the answer, which is this in the US we have it in India as well, but it's not liquid. The market is not liquid. So what you should remember in the context, this is important to know that in the context of, so this actually is, 1 minute, let me, 70, 71, I'm just trying to see where, okay, so this actually, this point about financial planning should go into page 71. Okay, they should go into page 71, under page 71. Right. They should actually go into page 71 because that is what is uh, inducing me to make that comment. So this should go under page 71. So our first point is about financial planning. And then just as a summary to this is the last page of this chapter. So we can just add this other point about tips also. Tips is, what is tips? Does anybody know what is tips? We have discussed it before actually in the in this course. Anybody? Tips? Not what you give to the waiter at a restaurant, but in investing, what is tips? Especially in the context of inflation hedges? No? Nobody? Okay. So you read all this tips. This is what tips is. I've shown you this before actually. So what you should remember is it should strike you, because Graham has not mentioned it, but I'm mentioning it, that when you are going through this kind of a discussion, the entire chapter is on investment and inflation and about how do you solve the problem of inflation, because you may get a good return on investment or you're wiped out by inflation. So how do you find a good hedge against inflation which will give you a huge return if there's high inflation and a low return if there's low inflation. So on that point, of course, it's impossible to ignore tips. That's why I'm mentioning it, that you should remember, it should strike you that on this point, it is important to discuss the question of tips. So what is tips? You can read this on your own. But basically tips is something where what they do is they make sure. So if you're seeing a tips yield of say 1%, okay, so and if you see 1% tips yield for 5 years, what you can be assured is that that 1%, if you leave out the reinvestment risk, okay, remember in the case of YTM, that is also a YTM. The tips yield is also a YTM. So in the case of YTM, if you remember, what we said was that there is the reinvestment risk, okay, you have to remember that. Okay, the YPM assumes that the interim coupons can be reinvested at the YTM rate, right? So uh, with that caveat, okay, always any kind of YTM kind of discussion, any discussion where you're basing something on the YTM and saying, oh, we are going to earn this return, which is in the YTM, always qualify that statement by saying that uh, provided we are able to invest the interim coupons also at the YTM rate. Because if our reinvestment rate is lower than the YTM, then the realized return will be less than the YTM. If the reinvestment return rate is higher than the YTM, then the realized return will actually be higher than the YTM. So we don't really know what will happen because we don't know what's going to happen to rates in the future. So this is important to always qualify that statement. But in that situation, given that qualification of the yield YTM on a tips, uh, having made that clarification, now with respect to a YTM on a tips, the YTM is what you will realize after inflation. So suppose somebody is offering you a 1% tips, okay, for 5 years. That means you are guaranteed at least inflation will not subtract from your return. So even if inflation runs at 23% for the next 5 years, um, average annual inflation is 25%, 23% over the next 5 years, you will still get a 1% real return. You will not get a negative real return because the way the TIPS works is they look at CPI basically, and here mainly they look at CPI, and when yeah, so you can see here they basically give you the adjusted principal, and so what they're doing is they, instead of adjusting the coupon, they adjust the principal in such a way that the given the fixed coupon and given the inflation, we, we increase your principal compared to what you invested with us. Increase your principal, so we make sure that you earn whatever you would have earned if there had been zero inflation. So basically give you the guaranteed return. So this is an important thing to remember. In India also we have this kind of system, but the market is not liquid. The US is very liquid. US tips, you can actually buy this stuff at a pretty low kind of transaction costs. Very developed financial markets in the US. So you can actually buy this stuff see, you can buy it here from Treasury Direct also. See this? You can buy directly from the Treasury, the tips yield. Okay, learn more about this. Please make sure you study all this. Okay, now let's go to okay, so that's tips, right? So tips is also something you need to know. Yeah, so what we are doing, why are we mentioning this? That best hedge, because we are all discussing hedges against inflation, right? The best hedge against inflation so for, I'm just writing this for bond investors only. Bond investors only. Best hedge against inflation is, okay, hedging for bond investors only is tips. That's basically what I'm saying, right? Here, best hedge against inflation is tips. So you should not have a discussion about the problem of inflation and how do we deal with it in an investment context. You cannot have a discussion about that without mentioning tips, because this at least guarantees your hedge protection against inflation. This is a real hedge because the mismatch is the least. Okay, so basically all that happens is you will get an inflated principal and you'll get the payment for any kind of inflation, any rise in the CPI since you bought the bond, right? So this is tips yield is very important, right? Now, okay, so here we are at 2:30 actually, so we can I'll let the class go, and then if there are any questions I'll take the questions. At 2:30, right? We're 1 minute over. Okay, all right, so your class is dismissed. Okay, and so everybody can go, and whoever has any questions can, okay, there's a chat box, there's a message. Oh, okay, Aditya has come back. Okay, no problem, so I'll give him attendance, no problem. Okay, 1 minute. So all right, so we'll give attendance to Aditya. Then in that case we'll give it to anybody else also who has come later on. If they're here, we'll at the end of, we can always do that at the end when we are actually so I can close the, so okay, I'll do that for you, Aditya. Just stay on there, stay online. In the meantime, let me just see, because I'll stop the recording. If there are no technical questions, then I'll stop the recording. Anybody has any questions?
No, sir, no technical question.
Okay, no problem. Okay, no problem. So then what I'll do is I'll let me stop the recording, and then I'll take care of Aditya's attendance as well as anybody else who's entered late or something like that. Okay, so well, let me open the main window first. So we have this nicely saved. So we have it